Hi, Larry.
Okay, hi. It's Larry McDonald here with Craig Shapiro with the Bear Trap Support. It's got to be one of the biggest Fed meetings in years. So if we're really going to kick off an easing cycle, a lot of things are going on. A lot of trades are starting to work that haven't worked in a while. We run behind us a Bloomberg chat with professional investors, buy side hedge funds, mutual funds, and pension funds since 2010. It's a revolutionary platform where we democratize information. So Craig and I are talking all day to the largest fund managers in the world, and we recap that conversation for the wealth managers, the family offices, and people that don't want to sit in front of Bloomberg all day. I don't blame them. But Jose, why don't we kick it off with the first slide? I want to kind of go into before the meeting here, get into at least one slide. Okay. Well, I wanted the BCom versus the BCom slide, but the last one I sent you. Well, we're waiting for Jose and the team in New York. Craig, so today, let's just cover today, first of all.
Yeah.
So I'll ask you the question. Over the last, during the quiet period, it looked like the Fed brought out some of their pawns, Bill Dudley, Nikki Leaks from the Wall Street Journal, and they tried to talk the market into 50 basis points. And then now today, the conversation behind me with the institutional investors, it looks like there's a little bit of a walk back on that with some of the Fed speak.
Yeah. No, it was bizarre. About a week ago, before the leaks, we had a 90% chance or so of a 25
What was the
basis point.
percent?
About 90% on Wednesday of last week was about a 90% chance of getting 25 basis points for today. And then Fed rolls out Greg Ip, Nick Timiraos, the Reuters or the FT reporter, Bill Dudley, a few John Hilsenrath, and I guess tries to push the market to thinking that 50 was on the table, got the odds up to for 50, close to 70%. And then this morning we had Bullard, and then I think most importantly, Mester, who was at the Fed if only 3 months ago, basically saying now they think 25 is probably the right move. So kind of going into this meeting about a minute to go, we're close to 50-50 shot. I mean, some people are going to lose decent amount of money trading, depending on
Yeah,
how
so
things turn out.
normally the Fed is showing their hand more forcefully. Normally, there's less uncertainty or certainty around what they're going to do. The point I made, Craig, is that with mortgage rates, which we'll get into in a minute, but they've already cut rates 100 bips because mortgages, the 30-year mortgage is down 100 basis points, and refi activity. We're going to get into that in this presentation. Refi activity is exploding. Look at the Bloomberg Commodity Index bouncing. Look at core services. I mean, you can't fake super core. I mean, that's inflation, right? It's like literally two standard deviations outside the 2013 to 2020 norm, right? So that's how much inflation is baked into the cake.
Yeah, here we go. All right. They go by 50. 4.4% end of 24. That's hawkish. 3.4. That's more on the hawkish side. Bowman dissented. It's kind of a mixed bag. I mean, market's reacting positively here to start. We'll see. Um, Surprised to see the dissent. The dot plot is very important, and the dots for the end of this year, 4.4, which is not really as dovish as it could have been. Um, and for next year, 3.4, market was at 2.9. So
Yeah,
you know, we're
the Fed statement has tons and tons of edits. So they added objective. Our committee remains objective, but remains somewhat elevated in terms of further progress toward. Yeah, that's the thing. For further progress toward the 2%. So once again, the point we make in our book, When Markets Speak, is the 2% Fed target. And this is a bestseller on Amazon here, When Markets Speak. The 2%, it's bullshit. Okay. There's no 2% Fed target. The new target's going to be 2.5, and then they'll eventually work it up to 3. When you have $35 trillion of debt, and you've just put on, you're putting on $1 trillion every 100 days. The only way out of that is what we call either a debt jubilee default or financial repression, where they keep interest rates below the rate of inflation. They want to keep interest. That's why we're getting 50 bips. Interest on the debt is $3 billion a day, $1.1 trillion a year. Economic data doesn't matter anymore. They have to get the Fed funds rate down because of the interest on the debt. And this is the one thing you won't see in the press conference. There won't be one reporter in there that talks about the reality of the situation. The reality of the situation is interest on the debt is $3 billion a day, $1.1 trillion a year, and they got to get rates down, even though essentially they're cutting rates 50 bips
Yeah.
with an economy that's
right.
reaccelerating.
I mean, this is their attempt, I think, at like a hawkish 50 basis points, right? So they're getting off to an aggressive start, but they're trying to guide the market in a way that suggests that they're not going to be repeating 50 basis point cuts at every meeting. They do that by putting in a dot plot that doesn't show 50 basis points at every meeting. And so, and then for the market, had been looking for basically 8 cuts between now and the middle of next year. And, the Fed is kind of pushing back a little bit and saying that's not gonna happen. Look, we had a market that was pricing in 2.9% for the 2025. There's only 2 dots that are down now at that level.
Now walk us through that slowly, Craig, around the dots versus where the street is.
Yeah. So basically going into this, the market had an expectation that the Fed would engage on an aggressive cutting cycle over 200 basis points of cuts for the middle of next year. And then by the end of next year, by the end of 2025, down at 2.9%. As of this dot plot, which I'm just going through right now, the median dot for next year is at 3.4%. So we're 50 basis points higher than where the market was expecting rates to be at the end of 25. And only 2 dots are down at 2.9%. So this is the Fed's attempt at trying to tell the market not to get over its skis aggressive on its expectation for significant cuts. Now, we'll see how the market reacts. Typically, when the market gets 50, it's going to keep saying, well, we're going to, we want 50, we got 50, let's get more. But this is a hawkish 50. If there even is such a term, it's hard to think about cutting rates by 50 basis points as being hawkish. But this is Fed pushing back a bit against the market expectations for easing. We'll see if it, we'll see.
Yeah, but once again, it's all a charade, right? If you're too dovish at this point, they risk massive inflation acceleration, right? So, but once again, interest on the debt is $3 billion a day, $1.1 trillion a year. So they have to get rates down, right? They have to. Interest will overwhelm. We're running deficits of like 6% of GDP. So they won't admit to the public that their new inflation target is really 2.5 to 3%, but they're going to slow walk it as carefully as they can to that. But like you said, just like this is a classic thing they would do. They cut by 50, but then try to sound
yeah.
hawkish.
And look, I think equities are obviously responding quite favorably to this. Gold is moving, Bitcoin's moving higher. It's interesting that yields are reacting. The dollar is weakening, which is to be expected. And yields right now are not really reacting dovishly, right? I mean, basically, yields are initially spiked lower and now are kind of grinding back. So we'll see. I mean, I think Powell will have a lot to say, obviously, when he speaks in the next 25 minutes about, why this decision today, what was so dramatic about the change in the economy that necessitated a a reduction in 50 basis points. I agree wholeheartedly that in the background here is this idea that the Fed needs to lower interest rates to help the government, although this is never going to be something that is discussed outwardly because of the independence of central bank policy and treasury policy. Um, but I think there is some mixed messages here, and for an economy that
Well,
has started to roll over, we'll see. I think that the economy and market participants are going to want to know that more easing is coming, and we do have that in the dot plot, but it wasn't as aggressive as it could have been.
so Craig, one of the clients in the chat. So once again, we run a Bloomberg chat with hedge funds, mutual funds, and pension funds since 2010. It's a revolutionary, groundbreaking venue where we're talking with some of the most largest professional institutional investors in the world. Um, so the Fed sees rates at 4.4% by year end and 3.4% in 2025. So the 4.4, Craig, walk us through that. Like, so in other words, how is that hawkish? I mean, 4.4 right now, Fed funds at
It's
5.5.
yeah, look, it's hawkish relative to expectations. So the market has been pricing in a more
Yeah, Goldman was at
aggressive.
three. Goldman was at 75 basis points between now and the year end, right?
Yes, and so that's basically what we're delivered. I'm talking not less about where Street and Wall Street consensus is, and more about where the actual market had been pricing. And so,
Yeah.
the market for the end of 2025 was looking for rates down at 2.9% or so. And so, for the Fed to come in and say it's 3.4, that's a surprise relative to expectations. Now, the market may not believe the Fed, and we may just say this is just the Fed's way of slow playing this. They're eventually going to get there, and it won't be a big deal. But I think there is some
So
informational value in what the Fed is trying to do here. They're trying to tell the market to slow down its expectation of rate cuts because the economy at this point, after printing what looks to be 3% GDP in the third quarter, that's the Atlanta Fed's most recent estimate. The economy
so they're
doesn't.
cutting. They're cutting. Hold on. We got to have a conversation. So they're cutting 50 bips with Atlanta Fed GDP at 3%.
That's correct. That's
That
correct.
is financial repression. Like
That's
I
correct. That's
need to
correct.
get rates below the rate of inflation. When markets speak, bestseller on Amazon. It's literally top 10 right now on Amazon and finance. Pick it up today. Craig, so one of the things that the clients, the buy side institutional investors have been talking about the last 3, 4 weeks is oil in China, is utilities and staples. So you see this move in oil, um, and you look at what's happening in China around the economic data. When you talk to the best consultants in the world, we in the chat we have one of the best consultants in the world in China, and the situation has been pretty dire in terms of dramatically slowing down economy. Just look at Chinese bonds, look at Chinese equities, and so you've got this big slowdown in China. You've got oil pointing toward that. You got rates. So rates, oil, China data are all pointing to something behind the scenes that's actually driving the Fed, right? So in other words, the U.S. economy has been stronger than the rest of the world. Over the last year and a half, the dollar's been strong. Dollar's weakening now because the Fed's finally catching up with the rest of the world.
Yeah. Look, I think the slowdown in China has been going on for months now. And the calls for China stimulus have been lower than expected, right? So the reaction from the government has been not as aggressive. I think the Chinese government is waiting a bit for the US political outcome. Are they going to be dealing with a Trump administration in a heavy tariff regime or not? And so I think they're in a bit of a wait and see mode. And so there's been follow on into Europe, specifically Germany, which has also been struggling and showing decelerating growth momentum. So yeah, I would agree with you. I think that there is an issue in global growth momentum, which is part of maybe what the Fed is trying to get in front of a little bit. And so we do have 3% GDP in the US, but the rest of the world is showing signs of deflationary momentum and decelerating growth. So Fed is trying to get a bit ahead of that. But with stock market at all-time highs and credit spreads incredibly tight, and 3% GDP, there's an element of why are we rushing? Why are we trying? What are we trying to get ahead of? Why are we forcefully trying to get and quickly get that back down to neutral? Powell has a lot to will have a lot of explaining to do.
Okay, so we have the problem in China. What else is driving the Fed? Because this program, the Bear Trap Support, Craig, you've been great contributor this year, and so let's talk about the reality of the situation. Things that the media is not really talking about. Like what's really driving the Fed? Why are we getting 50 basis point rate cut with Atlanta Fed GDP at 3%? I mean, think of the insanity that just sounds absolutely insane, right? The problem is you've got hundreds and hundreds of billions of dollars of loans because the Fed suppressed the cost of capital 2016, 2017, 2018, 2019, all those years and many years forward, they suppressed the natural cost of capital. So they forced banks into moronic lending on that left-hand side of the screen there, complete idiocy loans, right? That are sitting on all the bank balance sheets. They're sitting all over the world. And we know we had a banking crisis in 2023, excuse me. And so this is a problem because a lot of this financing rolls over in the next, like 2024, 25, it's like over close to $1 trillion that rolls over. And you can see there on the top right-hand corner, your financing is going to go from 2.5% to 3%, up to 7%. You can see there, CMBS triple Bs are literally near peak COVID wides, right? And so this is like they're trying to get out in front of a really nasty financial crisis that's coming at us by easing policy. So once again, the beast inside the market, this credit risk is kind of forcing the Fed to cut rates when we just showed you super core inflation is 2 standard deviations outside the norm, which we lived with from all of 2010 to 2020. Craig, what are you seeing here?
Yeah. I think there's and I've been saying this for a few months, but the long and variable lags in monetary policy in the tightening cycle, look, they took longer this time to impact the real economy because there were droves of borrowers, mortgage borrowers and corporate borrowers that were able to borrow at historically low rates after COVID. And so folks have locked in mortgages at 2.5, 3.5%. Companies have low locked in borrowing rates. And so the historical tightening that we had really didn't have the impact that it normally would have on the real economy. But it's not like it didn't have a impact. It just took longer. And so by the second quarter of this year, what I felt was like we finally got to the point where the economy was starting to show some signs of strain. And I think that's what we've been dealing with now over the course of the last, 2 to 3 months is an economy that really can't handle 5.5% rates. And is starting to slow, right? The labor market is starting to show signs of slowness. Yes, headline inflation has started to come down, but core inflation is just not coming down fast enough yet. And so consumers are really pinched. Wallet share that continues to have to go to energy and food is lowering discretionary items, and so retail and other consumer stocks have had some trouble.
Yeah,
so
if
I
you
think we're
listen to
getting it.
CFOs, and Robert Ben Battenberg went through 85 companies, and we found a large list of CFO comments about the consumer. And you saw with Ally last week, Ally Financial, the tertiary financials are admitting to you that the consumer is in a ton of pain. Delinquencies are on the rise. Capital One is trading the cheapest to American Express since COVID. In other words, that's your subprime lender. And so, yeah, the middle class is getting hammered. Back to my point earlier, Craig, on China. This is exactly what we're talking about here. Is the bearishness on China equities is so off the charts, right? And so that's because the economic data. And now that the Fed can ease, now that the Fed just eased 50 bips, one of the things that institutional investors point out to us all the time is China has a very difficult time cutting rates by themselves without cover from the Fed, right? So now that the Fed's cutting, it's potentially bullish for China because Chinese equities, and you look at the way JD's acting, you look at K-Web versus the Qs outperforming for like the last 2 months, I think. You look at Baba, you look at JD, JD's breaking out. And so you've got these China trades that if you get some love there on the RRR, which you probably get in the next month, 3 weeks, because the Fed just eased, that could give us a break on China.
Yeah. Well, I think China sets up well for, for next year.
Yeah, you get some tax loss problems, right?
Yeah, I think we're going to see, a better, more allocation of capital into China as the Fed cuts rates and removes some of the impetus to store wealth in America with a weaker dollar, maybe some slowing growth momentum. I think with respect to China, look, consensus is for weaker growth, and so it's hard to disappoint when people are already fairly negative, but we still have some uncertainty to get through, and broadly speaking, I think this election uncertainty in America is slowing down global growth momentum. I think it's slowing down U.S. economic momentum. I mean, consumer outlays starting to slow, and corporate outlays, corporate hiring, corporate capex, moving through and into an uncertain period here. If you
So,
don't
Craig, we're
know
getting
what,
some love from the small caps versus the Qs.
yeah, you can see that there's a little bit of that. So, Nasdaq is underperforming by about 80 basis points
So,
post the
yeah,
Fed
so
meeting.
the Russell's outperforming the Nasdaq by almost 100 bips.
Yeah, about 100 bips or so. Right now, gold is really, making a new high here for the day. Probably will take out highs from earlier this week or from last week. I mean, to your point earlier, Larry, for a Fed to talk about this level of easing with an economy that maybe doesn't need it yet, suggests less worries about inflation, precisely likely at the point when they should start worrying, and gold will anticipate that, and so gold's having a bit of a breakout here. Bitcoin probably could follow on that front. So, and what we have also is we have a big curve steepener, and I know you were trying to show that chart earlier, but curves steepening back out here, bull steepening as 2-year yields
So you describe
falling.
it. So your bull steepening is when the 2 year
Yeah,
yields falling
the yields on
faster.
the short end, the yields in the front are falling, and the yields in the back are rising. And why are they rising? Because, well, either this is going to work and we're going to stimulate, and the growth momentum is going to be better, in which case inflation will move back up in the 10 to 30-year period. And so, why would you want to own a treasury bond at 4%? That could be part of it. Or people might be thinking, that it's the Fed is making a mistake here. We shouldn't be tightening. Shouldn't be loosening. This is bad for the dollar. I don't need to own or want to own long duration bonds into an economy where the government is, fiscal deficits are 7% of GDP, and so we know the government borrowings are going to continue to exponentially grow. So there's a bit of both of those dynamics in play here for curve steepening.
Okay, so one of the things that this chart shows is that you've got um, on the far right, it's hard to see, but the staples have only been here. Yeah, that's better. Thanks, Jose. The staples have only been here 3.5 weeks the last 20 years. So your consumer staples, um, we think a lot of the things that worked well into the Fed meeting, like the staples and the utilities, are going to reverse. So your staples, in terms of how far above the XLP, think of what staples are. You're talking about Campbell Soup, Merck, companies that do well in recessions. So companies that do well in recessions have dramatically outperformed the market. As you can see there, 11% above the 200-day moving average. That's very rare spot. Jose, can we have the XLU, please, as well now? The XLU versus the 200-day moving average. Yeah, the dollar is really starting to break down now. So the um, I think this is big, big. I think this is big technical level. I'm going to take a look right now, but give me one sec. Yeah, so the XLU. So look at this. The XLU has never been here, Craig.
Wow.
This
Yeah.
is 19% above the 200-day moving average. So what's weird is the Fed. This is probably something that's really bothering the Fed and probably drove them toward 50, because even though the Atlanta Fed data is at 3%, all the money has, like a lot of hot money, has moved into utilities. Utilities are crushing the Qs. I mean, utilities are crushing Apple this year. Utilities are crushing Microsoft this year. Utilities are crushing Google this year. And so a lot of money is the hot money is now moving into utilities and staples. As you can see here, the utilities have never been here. So we're starting to see, we've seen some clients shorting the utilities this week, shorting the staples and playing for a reversal.
Yeah, look, I think ultimately the decision on sectors will be determined by whether or not the economic momentum continues to decelerate, or do we get into a situation where this easing is enough to arrest the growth decline? We have our soft landing and things are great. And so I think to the extent that we get better data in the coming weeks, people will shift out of these defensive sectors into more cyclical sectors and inflationary sectors. And to the extent that actually the economy does roll over and the vortex of China and Europe and Germany's decline kind of brings us lower alongside the election uncertainty, then that rotation will be very difficult to do. In which case, folks who are already long these staples, utilities, and healthcare will find really nowhere to rotate into, and will start to reduce equities as an asset class. So I think that's kind of where we sit. My view
And
is
you
the
know, and you
data.
know, and you, Craig, you've been talking about this growth scare. So when the Fed starts to cut rates, the fear is that they see something, right? And we
Yeah,
know they're worried about China. We know that there's a growth scare, and so the S&P earnings next year are supposed to be $275, right? And so what's been happening is as economic risk comes in, like think of like the beast in the market, or think of like a storm coming in from offshore. Like the Fed's concerned about something. That's why they just cut 50. They're concerned that they're behind the curve. There's some concern there, and you could see the way utilities are trading. You could see the way treasuries are trading. You see the way oil's trading. So something is out there, and you're at a point here where the dollar's breaking down, and so the Fed is trying to do more because they see something, and that's the fear that's in the market now. At the same time, what investors should do is go to cash, but it's the classic, they're going from the roulette table, from growth stocks
to the
to
craps
the
table.
craps table,
Right.
to utilities and staples. In other words, people should just raise cash if they're concerned. But because there's no certainty of recession, the money just literally about $1 trillion left the NASDAQ 100, and it just went into value stocks and growth stocks. I'm sorry, value stocks and staples. I want to bring in Robert Ben Battenberg. Rob, you've been watching things. You've been handling the chat. Rob, what are the clients saying? Like, what's because Craig and I have been running this our chat here. But what have you been seeing from the institutional clients the last like 10 minutes, 15 minutes?
Well, you could you could see that the market has been pricing in more rate cuts, right? So expectations are now for an additional 200 basis points of rate cuts from now until the end of 2025.
Okay, so walk us through that. So in other words, um, the total amount of cuts, so the terminal rate, or the total amount of cuts, that's what's changed today. So give us the before and after.
Yeah, so we had I think there were about like 200 basis points of rate cuts priced in from now until the end of 2025, and now it's more closer to 250, which I
So an
mean.
extra 50 basis points of total rate cuts.
Right. And the Fed is basically saying we're going to give you 250 basis points of rate cuts, but that will last until the end of 2026. So their dot plot is projecting 250 basis points of rate cuts from before this meeting until the end of 2026. And the market is pricing in now a little bit more than that. So I think the big confusion was that, this morning there were some former Fed speakers because the Fed was still in the blackout period, so couldn't really speak themselves. So there were some former Fed speakers, Mester and Bullard, who were saying that they thought that 25 basis points today would be enough. So the market started rapidly pricing out, rate cuts for a 50 basis point rate cut probability. So it went from 72% this morning to 56% just before the Fed meeting, and the Fed did 50 basis points anyways, and it was kind of a surprise. And I think that really wrong-footed a bunch of people. But what it really opens up is the question is okay, the Fed for the longest time, since the financial crisis, has been hell-bent on forward guidance. They wanted 100% probability priced in of their move by the time of the Fed meeting. So if they were going to cut 25 basis points, they wanted 100% probability of that being priced in. And we never saw that on the 50 basis points. We cut. We never saw that the market was fully on board, fully 100% pricing in 50 basis points of cuts. And they cut anyways 50 basis points. So
Yeah, that's
that whole
interesting,
forward
Rob.
guidance is
No,
out
hold
the
on.
door.
Let's have a conversation. Okay. So what does that mean? So they never got the market to 100% 50 and they cut it 50 anyway. To me, that tells you they're desperate because they see something. They got to get rates lower. They got to get rates lower.
Well, or they want Kamala Harris to win.
Well, yeah, yeah. Let's do 50 right in front of the election, right?
Yeah, because I mean, for a Fed who has been extremely non-committal, took throughout the entire year has been walking this back, and then suddenly to make this about phase by the end of the summer. Um, I mean, we've been talking about how disingenuous and how misleading the non-farm payrolls were since basically the beginning of the year, because household employment as part of the jobs report never reflected the very same strength in the labor market that the non-farm payrolls had. The ADP numbers never really showed the same kind of strength as the non-farm payrolls. So the non-farm payrolls stood on themselves. They stood on their own.
And full-time jobs are down about 1 million, right?
Yeah, so there was
From the
never
high.
that justification for the Fed to believe that the labor market was this strong, yet they believed it anyways. And then suddenly, after the revisions, they do a mea culpa and they become the doves doves. And keep in mind that all the other central banks in the world, pretty much, except for Japan, have been much earlier with cutting, right? So the Fed was behind the curve, um, misplaced hawkishness or reluctance and then suddenly by the end of the summer, like in a month ago, they're turning dramatically dovish, and now they're cutting by 50 basis points. Uh, yeah, I don't know. For a Fed who claims not to be political, it's really suspicious.
Yeah, and you can see here the dollar making a big, that 2021 to 2024 trend line was broken several weeks ago, but now that local support has given way today. So a big move lower in the dollar. Hard assets are going to love this number. We've been talking about palladium and platinum. All the gold ever mined, gold's about a 16, $17 trillion market. All the gold ever mined in the history of humanity would fill up an Olympic swimming pool, but all the platinum ever mined and all the, say, platinum and palladium would only go up to your ankles in that pool. So one of the things we talk about in When Markets Speak is the dollar, is this move in the dollar, hard assets. The thesis of the book has been playing out. We wrote this book 2 years ago. By the way, shout out to Robert Van Battenberg. Rob, the hours and hours and hours that you spent on this book, When Markets Speak. You did all the research. You were just the foundation, really. And I owe you such a gratitude of just everything you did with the whole team. We had a team of 6 people. Rob pretty much ran everything. And you worked great with James Robinson, our ghostwriter. But Rob, this move in the dollar breaking local support. So where's the trade here? So EM outperforming equities or Brazil or hard assets?
Well, to your point that, the only sectors that are down are now the staples and the utilities. So what we saw,
Explain that
essentially
right now. No,
start,
so you mean staple? You mean today?
yeah, now, yeah, now.
Okay.
Yeah, Yeah, and they really started to break down after the Fed meeting. So, what we saw starting in July the 13th was this rush into defensives because Fed economic data really just started to slow down. Now the Fed has been cutting basically in an acceleration, a modest acceleration of the economy.
Powell's
And
starting right
that,
now, by the way.
I'm
Sorry to
sorry?
interrupt. I said Powell just started speaking. Just wanted to make sure you were
Oh,
Yeah,
aware.
yeah.
so
So,
it removes the justification to be in staples and utilities.
so why don't we take a break, Jose, while Powell speaks, and we'll during the press, and we'll come back right after the press conference. Is that okay,
Sounds good.
Jose?
Yes, sir.
Okay, thanks, buddy. Great. Jose, you did a fantastic job.
We'll be back. Current transmission for now.